Okay, welcome to this explainer. Today, we're basically acting as investigative journalists. We are leaking the real manual of wealth building and decoding the financial system's unwritten rulebook. You see, the financial advice most of us receive is just full of noise. It's totally designed to get you to do something, right? Buy a product, open an account, pay a fee. But the ultra-wealthy? They're playing a completely different game with completely different rules. And today, we are going to look at the exact math behind how they do it.
So, let's start right here. Look, what you're usually told by the financial industry, stuff like complex gross income budgeting, or the hype around active stock picking, and this massive fear of debt, all of that is literally designed to just sell you products. But what does the math actually say? The math shows us how the ultra-wealthy quietly multiply their capital using strict money sequencing, net income realities, the absolute boring consistency of index funds, and actively weaponizing debt. It's a totally different reality.
All right, here is our agenda. Think of this as your table of contents for the 5 unwritten rules of money. We've got 1, the optimal wealth sequence. 2, the real cost of housing. 3, index funds versus stocks. 4, the IPO lockup trap. And finally, 5, how wealthy people weaponize debt. Let's just dive right in.
Section 1, the optimal wealth sequence. Or actually, let's just call it the hierarchy of capital. The industry loves selling you complexity, but the real secret to financial security is simply the strict sequence of your money.
You see, there's an exact mathematical order of operations here. It's almost like a giant puzzle. Before you even think about buying a single stock, you absolutely must build a cash firewall. That's a starter emergency fund of about $1,000, just so you don't have to liquidate your investments when, your car suddenly breaks down. Step 2, capture your employer's guaranteed 100% match. There is literally no investment on earth that safely returns 100% on day one. Take the free money. Step 3, kill that toxic 20% credit card debt. High-interest debt is just a guaranteed negative return. It's a wealth destroyer. And step 4, funnel money into a tax-free Roth IRA. This sequence is a mathematical ladder. If you skip a step, it's going to cost you real money in ways that are genuinely hard to recover from.
Moving right along to Section 2, the real cost of housing, also known as the American Dream Trap. Let's see how banks use gross income to set buyers up for a massive cash flow nightmare.
So you've definitely heard this famously misleading anchor, the golden rule, that you should spend no more than 28% of your gross income on housing. For ages, the industry has pushed this exact number. It looks simple, right? It looks tidy. But guys, it is fundamentally broken. Why? Because it calculates against your gross income. The money you haven't even paid taxes on yet. It's wild. Let's do a real teardown. Take someone making $80,000 a year, buying a $280,000 home at a 7% interest rate. On paper, the bank says, sure, your budget is completely fine. But once you add property taxes, insurance, private mortgage insurance, and let's say a conservative 1% maintenance reserve, well, housing actually consumes $2,703 a month. Now, to put that into perspective, for an $80,000 salary, your net take-home pay is only around $5,000. That means housing consumes a suffocating 54% of your net take-home pay. That is before groceries, before daycare, before literally anything else. The bank approves a ratio on a piece of paper, but you have to live in the net income reality. All right, Section 3, index funds versus stocks, or the market casino. Let's look at the actual data behind individual stock picking versus the mathematical truth that insiders know. Think about this staggering reality. Over a 20-year period, 94% of highly paid, active professional fund managers totally failed to beat a simple, boring S&P 500 index fund. 94%. We're talking about professionals with crazy expensive Bloomberg terminals and entire armies of analysts, and the vast majority of them underperform a fund that requires absolutely zero skill. None. And to make it worse, they charge their clients massive fees for the privilege of, losing to the market. Unbelievable, right? Warren Buffett actually proved this with his famous $1 million bet. Back in 2008, he bet the absolute smartest hedge funds on the planet that his passive index fund would beat them over a decade. And guess what? He was right. His index fund returned 125.8% over 10 years, utterly crushing those hedge funds, who only managed to scrape together 36.3%. The real lesson here isn't just about index funds. It's that trying to outsmart a highly efficient market is just incredibly expensive and, mathematically speaking, highly improbable for almost everyone.
Which sets us up perfectly for Section 4, the IPO lockup trap, or the gravity of public markets. Let's talk about those massive, heavily hyped public debuts and the hidden dangers they carry.
So, when a company goes public,
A ticking 90-day countdown immediately begins. On day one, everyday retail investors buy in on all the euphoria and media hype. It spreads like wildfire. But what they usually don't realize is that the insiders, the founders, the private equity investors, they are under a strict legal lockup period, usually about 90 to 180 days where they are absolutely prohibited from selling a single share. But right at day 90, the dam breaks. Those early insiders, who might be sitting on 10x or even 20x returns from when the company was private, are finally legally allowed to dump their shares, and that creates a massive flood of supply crashing onto the market.
When those early private equity investors and founders basically cast their vote by rapidly cashing out at that 90-day mark, it really forces you to ask yourself a hard question. Why on earth are you holding what they are selling? I mean, they have the better information. They've been in the internal engineering reviews. They know the actual raw financials. If they are sprinting to the exit the very second they're legally allowed to, what exactly do they know that the average retail investor watching the news doesn't? It is essentially a massive transfer of risk from sophisticated early investors straight to the general public.
And finally, we arrive at Section 5, how wealthy people weaponize debt. This is truly the final boss of finance. Let's see how the ultra-wealthy use debt entirely differently than the rest of us.
Okay, let's define buy, borrow, die. I know, it sounds intense, but it's an elegant and completely legal mechanism used by the ultra-wealthy. Imagine for a second someone has $100 million in stock. If they sell it, boom, they owe $20 million in capital gains taxes. So they just don't sell. Instead, they go down to a private bank and they borrow $50 million against that stock to fund their lifestyle. And because loans are not classified as income, they never trigger a tax event. Brilliant, right? The mechanics of this work flawlessly. Like I said, because loans aren't taxed as income, they completely bypass that $20 million tax bill. They just live off the borrowed cash. But here's the real kicker. When they die, the original gain is wiped out for their heirs through something called a step-up in basis. Their heirs inherit the stock at its current appreciated value, they pay off the loan, and decades of massive compounding growth are literally never taxed. Not once. It is the tax code functioning exactly as it was written, but utilized by people who actually understand the unwritten rules.
They also deploy strategies like the carry trade. Here's how it works. A wealthy individual with a bunch of assets can borrow really cheap money, say a margin loan at 4%, and then invest that borrowed money right into higher-yielding assets, like 7% dividend stocks. They generate pure passive income simply by pocketing that 3% difference. They are literally making money on money that isn't even theirs, simply because they have the collateral to access cheap credit. It's a real game changer. So, now that we've decoded the unvarnished truth about your wealth sequencing, the hidden math of your housing costs, the absolute reality of index funds, the mechanical traps of IPOs, and exactly how the wealthy weaponize debt to bypass taxes entirely, what game are you going to play tomorrow? Are you going to keep following the industry noise that's just designed to sell you products? Or are you going to start applying the math the insiders actually use? The rules are sitting right in front of us. It's up to you to use them.